Hey guys, this is George David. In this video, we're going to be talking about intuitive surgical stock analysis and how the company is poised to surprise and beat on Q1 2021 earnings. This is coming up on April 20th, 2021, and how they'll project out to a nice 5, 10, 15% upside in the short term with the stock in the next coming days and weeks. So you don't want to miss that analysis. We'll break that down. And as always, we're also going to be touching upon some important factors in the stock market as a whole and how those things will be affected with the bubble that's forming in the stock market and whether a stock market crash is going to happen. So we're going to look at some of those factors. And we're also, most importantly, going to dive into intuitive surgical and understand the investment play both in the short term and in the long term. So let's dive right into that. All right, so in this video, we're going to be talking about number one, intuitive surgical stock analysis and how the company is poised to demolish Q1 2021 earnings expectations. Then we're going to be talking about number two, today's stock market news. Number three, is it time to buy, sell, or wait on intuitive surgical, both from a short-term and a long-term investing standpoint? And finally, we're going to wrap it up, as always, talking about triggers for a potential stock market crash and what to watch out for. All right, so let's dive right into the next section. So currently, Intuitive Surgical is doing $4.4 billion a year of revenue. The company is also poised to do about $15 billion a year in revenue, about 5, 10, 15 years from now. So that's currently with the trajectory of the company in relation to the entire growth of the healthcare industry, what Intuitive Surgical is looking at from 4.4 to $15 billion a year. This gives us a growth multiplier of 241%. Now, with that in mind, from a long-term perspective, the company is a good, solid investment choice. The healthcare industry is growing. Revenues are consistently growing. Now, it's not the biggest or the fastest growing entity out there like a Tesla or a Zillow or a Dexcom, but 241% upside on the company is very good alongside revenue growth. But wait, we haven't even touched the short-term investment standpoint of the company. We're just talking about the long term right here, and we still don't know if it's right now the right time to buy, sell, or wait on Intuitive Surgical. So we're going to be touching upon that in just a moment. But is Intuitive Surgical a mass use stock? Well, basically all of the healthcare industry relies on Intuitive Surgical and their equipment, their state-of-the-art equipment in some extent. So yes, do you interact with the company? Yes. And do you most likely use it? Well, at some point in your life, we all have procedures and different things like that. So yes, the whole healthcare industry relies upon some of the most sophisticated technologies that Intuitive Surgical has. It is a mass use stock. Maybe it's not in the same manner as Amazon, but it does permeate to different parts of the economy, and it's a very tangible good. Now, moving on to the next section. Let's talk about today's stock market news. Now, again, we keep drilling this over the past couple of days, but when you really look at the stock market as a whole, you try to drill down what the news is going on. There's really not much going on outside of the fact that the economy is growing. Unemployment rates are continuing to go down. That's great because there's more spending. Fed fund rates continue to be very good for business spending, mortgage origination, all those things that you need to get the economy driving into gear. Once again, with that in mind, since those are pretty much status quo, the only things we have to look forward to is, number one, corporate tax rate increases. Again, 28% is the goal, but most likely the consensus is corporate tax rates are going to be increased from 21% up to 25%. We'll touch upon how that affects both Intuitive Surgical and other economic conditions and whether that's going to trigger a stock market crash. The next one is, again, the Russia sanctions and Russia promise for retaliation in the market. That's an important one that you want to definitely not miss out on. I'll be touching upon that, how that's going to impact Intuitive Surgical, and that also might trigger in a second or third order consequence a recession down the road, and especially a stock market correction or crash. So you won't want to miss that. We'll touch upon that in just a second. Now, is it time to buy, sell, or wait with Intuitive Surgical? Well, the answer here is, if you're looking for long-term investing, and as I mentioned previously, Intuitive Surgical is a good long-term investment play. There's other companies that are stronger with greater growth, earnings potential, and revenue potential, and those companies, I like to double down in. Those are my all-in stocks. Intuitive Surgical is pretty good. It's a good diversifier in your portfolio, but if you're looking from a long-term perspective and your window of investment horizon is 5, 10, 15 years, then right now is definitely not the time to buy because valuations are overinflated. As I'll touch upon, as always, in my next slide, you want to buy the real dip, which is when the golden cross happens after a death cross occurs. As I always pull up, the last time we had that kind of opportunity was right after the financial crash in 2020 with COVID. You see this intersection there in May of 2020. That was the right long-term time to buy for most companies. Now, short-term is different. Short-term, and this is the most important thing with quarter one earnings, it is a good time to buy Intuitive Surgical. Not only have they been depressed and undervalued due to the fact that Corona impacted the economy, but it's more of a value play right now. And my expectation is with a strong economy, a lot of spending that's percolating into lots of business loan originations and just different factors in the industry. Well, Intuitive Surgical is poised to take advantage of that. That's why I believe that they're going to exceed earnings and adjust their guidance going into the future with a strong economy, a lot of spending B2B that's going on right now. So short term, it's definitely a buy. Now, why is there a difference between long-term and short-term investments? I'm going to show you that in just the next slide. And that's because, again, if your window of horizon is a good 5, 10 years, well, you want to make sure you buy at the right price. You want to be patient because you don't want to buy something at artificial highs and not be able to get out. If you're trying to get something here at March of 2000 and you waited to sell in, March of 2010, that's 10 years, you bought at a really high price. Your return there might have been only about 50% on the stock. So that's like a 5% return per year, let alone if you get panicked and you sell early by buying high and holding for a year or so, well, you would have lost there about 20%. Again, if you buy at the right time with long-term investing at the golden cross point in this graph in 1999, then you would have made a nice 30-40% upside in just about a year and a half. So that's why I always stress it. But in the short term, especially due to the fact that we don't have those same kind of tech bubble factors, although we do have an overinflation of the stock market, we do have an overinflation in the housing market. Right now, if there is a dip in a company or there's a stock that's about to beat earnings and we don't have something that's about to tank the stock market as a whole, then you definitely have the blessing to go ahead and buy right now if it's a short-term play. Only long-term, wait for that better opportunity to come in, and also consider some of those larger players with bigger revenue growth potentials. So as always, long-term, buy at the golden cross, but you got the blessing to buy in the short term. Now, as always, let's talk about triggers for a stock market crash to not only understand how the economy is going right now, but also to understand what might percolate into the next stock market crash. As always, that means number one, are we seeing higher interest rates? This affects spending, both in terms of B2B. Businesses are taking out loans at higher interest rates. That means that they can't afford to buy other goods and services and pay as many employees. That starts to cool down the economic growth and labor markets. Spiking oil prices, this impacts everybody. This permeates to every aspect of the economy. That's when you have consumer spending goes down because more of their spending goes to oil. That percolates into the economy, but it also impacts businesses because businesses then have to, transport their goods, and that increases in prices. Their goods, their inputs to that, those increase with oil because to manufacture it, a lot of things rely on oil. So that starts in combination with interest rates slowing down spending, segmenting that out to only one part of the economy. That impacts spending as a whole, and that drives things down. Obviously, number three, the wild card here is a pandemic lockdown, which impacts spending as a whole. Again, this could be either a variant that comes out that's horrible and it forces lockdowns, or another pandemic that comes out that triggers that. So at the moment, the two things that we need to watch out for, and the big one here is the Russia sanctions, especially if you're looking at Intuitive Surgical as a long-term play, is although we don't do a lot of business with Russia, so we're not worried about a trade war, this becomes tangible if Russia, in retaliation, starts cutting oil supply. This raises oil prices. Eventually, we're going to start having rates to go up. And if oil prices start skyrocketing, so an oil price shock happens, then corporations can't easily, what is called cost push inflation, pass that along to their consumers. So this is something we need to watch out for, because what happens here is when oil supply gets cut, prices go up, and our trade partners we do a lot of business with internationally, such as China and the European nations, once those countries are experiencing higher oil prices, they can't spend as much on goods and services, and that will permeate back into the economy in terms of spending, and that's when you're going to start having companies miss earnings, whether they have to adjust guidance or they're missing earnings. Those larger entities like the tech stocks, once that happens, that's going to start triggering a bursting of this stock market bubble that we're in. We're not there yet, but this is something we have to really watch out for. Again, it's a second, third order consequence. Next, also, as we talked about, corporate tax rate increases will trigger a correction in the economy, and especially the stock market, but it won't necessarily impact GDP because corporate tax rates aren't increasing significantly. They're only increasing a little bit. It will ultimately impact earnings. Companies are going to have to revise guidance, but since earnings are a line item in an accounting procedure, with that little of a jump in corporate tax rates, this won't tangibly impact GDP or employment, because again, it's a line item in accounting. It's not necessarily taking money out that's being spent to buying other goods and services that are business related or hiring more people. So as always, if you love this material, smash that like button for me, just like you would want to smash higher interest rates that would slow down the economy. And if you haven't done so already, make sure to subscribe to the channel. I try to post great content every single day, and it will also help the channel grow to bring that to the other people that are out there trying to look for some sane financial advice. So as always, I look forward to making the next video, and I'll see you on the next one.